Ladies and gentlemen, good day and welcome to Q3 FY23 earnings conference call of Nuvoco Vistas Corporation Limited. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that company faces. The company assumes no responsibility to publicly amend, modify or revise any forward-looking statement on the basis of any subsequent development, information or events or otherwise. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Madhumita Basu, Chief Strategy and Marketing Officer of the company. Thank you, and over to you, Ms. Basu.
Thank you, Tanvi. Good evening, everyone, and a warm welcome to the Q3 FY23 earnings call of Nuvoco Vistas. I'm excited to take this call after the recently presented Union Budget of India for the next fiscal. It is very encouraging to see government's continuous thrust on infrastructure-led economic growth, which is a very positive read for the construction industry. The budget underpins infrastructure focus, inclusive growth, and higher consumption, which reflects good growth, good growth, good growth. A significant increase of 33% in the capital expenditure to rupees 10 lakh crore, thrust to fast-track infrastructure development, and 66% higher outlay at 79,000 crore for Pradhan Mantri Awas Yojana will translate into robust cement demand. Other factors like strong housing demand, improvement in rural sentiment, higher disposable income with change in tax slab, coupled with moderating inflation, augurs well, and Nuvoco is fully poised to capitalize on it. Looking at the economy on a medium-term perspective, while the budget itself is very promising, the India growth story also remains resilient. Various agencies worldwide continue to project India as the fastest growing major economy, which emanates from the buoyancy the economy has seen from the seamless rebound of private consumption post the COVID era. This has also given a boost to production activity, resulting in an increase in capacity utilization across sectors as reflected in the improving PMI figures, as well as high average gross GST collection on monthly basis. Measures taken by the government and RBI, along with the easing of global commodity prices, have also managed to bring down retail inflation below RBI upper tolerance target. Given this backdrop and coming to the industry performance in Q3 FY23, cement demand in East has witnessed good demand growth during the quarter on YOY basis, driven by rural housing and infrastructure segment, coupled with lower base effect of last year. However, looking at the dynamics within the region, the states of Bengal and Jharkhand witnessed subdued demand growth on YOY basis, moderately impacting our overall sales volume growth during the quarter. Nevertheless, we continue to register double-digit volume growth on a 9-month basis. North region also saw healthy double-digit growth led by higher execution of infrastructure projects and rural IHB activity. North prices remained stable during the quarter. Prices in East improved in the months of October and November with a pickup in activities post-monsoon and festive season. This was followed by some softness in December. Despite this, East region saw the highest price increase during the quarter among all regions, which benefited Nuvoco. Since then, prices have been range-bound with an optimism around price hikes on the back of robust demand. On the other hand, fuel costs are believed to have peaked during the quarter, and the recent softness in coal prices will certainly support near-term margins. In this backdrop, we continue to progress on our near-term plans with agility while building upon long-term strategic action. We have successfully launched our super premium cement variant Concreto Uno, which has unique water-repelling properties, protecting the house from water ingress, dampness, and efflorescence. This launch is in line with our continuous endeavor to service the need of individual home builders and enhance customer satisfaction. Just to remind, we have been continuously introducing new products throughout the year across our segments, including premium composite cement Duraguard F2F and premium quality ready-mix solution Concreto Glide. Further, in line with our focus on individual home builders, we recently unveiled our first direct-to-consumer home assist app, Nuvoco Nirman, that covers a wide range of information and guidance throughout the home building stages. We have also introduced Tech Express vehicles to provide on-site services to our customers. These initiatives will further strengthen our brand through phygital connect with the consumers and provide us necessary impetus to enhance our retail reach. We have been prudently prioritizing our capex on cost saving and sustainability projects like alternate fuel material handling facility at Vistas and Nimbol and railway siding. With the commissioning of co-processing system at Vistas, we have initiated feeding of alternative fuels in higher quantities. Work on other projects is also progressing well. Lastly, our other businesses of ready-mix concrete and modern building materials are on a steady growth trajectory. We have more than 50 operational ready-mix plants spread across the country and further working on opening more. Our ready-mix revenues improved by more than 20% during the quarter on a YOY basis with higher value-added product share. MDM has also been penetrating well into non-cement channels in North and West regions. A quick update on our ongoing growth and debottlenecking programs. Cement capacity expansion through 1.2 million tons per annum grinding Bhiwani cement plant in Haryana is going well. Civil and fabrication advancement is on mark and all major orders have already been released. This will take our overall cement capacity to 25 million tons per annum. Clinker capacity enhancement projects at Vistas and Nimbol through debottlenecking are also progressing well. Moving on to our sustainability initiatives. We remain focused on enhancing the use of alternative fuels, improving the share of composite cement, and conserving natural resources while giving back to the society in which we operate. Happy to share a few highlights. We remain steady on our thermal substitution rate at 9% sequentially, while improving 4% year-on-year during the quarter. With the ongoing investments in material handling systems, we are targeting to achieve an exit run rate of 12% by end of this fiscal. During the quarter, we added lighter aluminum body trucks for cement dispatches, an industry first. This will help reduce about 28 tons CO2 per vehicle in its life cycle by reducing fossil fuel consumption. At the same time, it will also increase the payload by 2.5 metric tons per truck per trip, additionally bringing logistics cost efficiencies. We have also introduced Nuvoco Mason, a masonry skill development program which aims at enhancing the masonry skills of youth and construction workers, empowering them, expanding their work opportunities, and improving their overall quality of life. Coming to the financial performance for the quarter, our consolidated revenue from operations during Q3 FY23 improved by 20% YOY to rupees 2,605 crores, with a 6% YOY improvement in sales volume to 4.5 million tons and better prices. As mentioned earlier, consolidated cement volumes continue to improve at double digits on a 9-month basis. We are consistently working on optimizing our operating costs through multiple levers. While our cement raw material cost increased by 21% YOY with higher slag consumption, In line with our thrust to sell more slag and composite cement, it helped in improving our clinker to cement ratio, which stands at 1.8x against India's average of about 1.5x. This is benefiting our overall cost line through lower clinker factor. We have also been able to effectively contain our power and fuel costs sequentially with our continued focus on optimal fuel mix, sustaining thermal substitution rate, and high utilization of waste heat recovery systems. We have also started operating our CPPs at almost all the locations. Distribution costs during the quarter primarily increased with the reimposition of busy season surcharge on the rail freight. Our consolidated EBITDA for the quarter improved by 13% YOY and 40% quarter-upon-quarter to rupees 272 crores. We have been continuously working to strengthen our balance sheet. Our net debt at the end of December 22 declined to rupees 5,165 crores from September 22 levels. Our interest cost has also been effectively contained with an increase of about 120 bips against the increase in repo rate by 225 bips since March 22, with opportunistic refinancing and debt repayments. Our capex spends for 9 months period stands at rupees 329 crores. Just to summarize before I open the floor to Q&A, the demand indicators with the government's consistent focus on infrastructure-driven economic growth, as visible in the recently announced budget, augurs well for cement demand. With higher allocation under PMAY and expectation of improvement in disposable income, we will continue to leverage our trade centricity to drive volume growth. Our capex priority towards diversification of footprint, cost savings, and sustainability projects are on track. We are also progressing well on our product innovation focus by rolling out quarter-upon-quarter. Lastly, with optimism around price hikes, robust demand, and peaked fuel costs, margins certainly appear to be improving from here on. With this, I will end my opening remarks. I am joined by Mr. Jayakumar Krishnaswamy, Managing Director, Nuvoco Vistas, along with Mr. Manish Agarwal, Chief Financial Officer of the company. We are here together to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhimanyu Kaliwal from Choice International. Please go ahead.
Thank you so much. Am I audible?
Yes, you are.
Okay, wonderful. Okay, good evening, Madhumita Madam and the rest of the management. Congratulations on strong performance this. But my question is, we can see that you improve dramatically on an operational basis. You become more efficient. However, there seem to be little capex to increase your tonnage. Now, competitors, they are aware.
We lost your audio, Abhimanyu.
Now, madam?
Now we are able to hear you.
Okay, so sorry. I'm saying that competitors are planning substantial eastern growth. I won't name a competitor. We listened to them a few days back. They're increasing 7 million tons in the east. And cement, now we know it takes 2-3 years for capacity plans to get implemented. But I believe, so do we have any plans to increase the capacity or maybe in ready mix, or will we just depend on debottlenecking because that is expected to give us 2 million tons per annum growth? Are we now showing any growth in top line, or we are basically now working on improving our EBIT margins by not really, by improving our efficiency and ensuring that, we're not doing much capex, so there's not much increase in depreciation. What is your plan, madam?
Okay, thank you very much. As we have mentioned during our IPO and then subsequent quarters, One of the principal objectives for the company, while we have number of avenues to grow in north, west as well as east, as I mentioned in the last quarter and the previous quarter, our immediate objective is to pare the debt and get the balance sheet hygiene going. And like I said before, with the passing of every quarter, we will give an update about how are we going to plan the future expansion programs of the company. We have very clearly couple of projects for us to expand for the future, as we mentioned during our IPO times. Also, during the last call and the previous call, I had mentioned that the immediate objective will be to debottleneck the company with minimum capex and take the capacity of the company from the current 23.8 to 25 million. And as we stand today in February, the kind of numbers we are looking is excess of 19 million tons this year. And if you really look at from 19 to 25, looking at a 6 million ton of headroom, we are very confident in the coming 24 months we would be able to utilize this head space so that we are able to get the growth going for the company like the industry growth. Around the same time next year or every quarter, we'll give an update about our large scale expansion, and with the changing scenario in the market in terms of demand uptake and the pricing improvement as well as the tempering of cost, we believe that as we get into fiscal 24, we will see improvement in margins, and that will help us come up with expansion plans for Nuvoco.
Wonderful. Thank you so much. That's all from my side.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just a couple of questions. So firstly, in the presentation, you've mentioned that East and North markets saw a double-digit growth, but our volumes were up 6%. So does that imply some market share loss over here? That's the first question.
Thanks, Amit, for that question. I lightly touched upon it in my speech. The demand scenario in East has been good. But if we take a closer look at the region dynamics, states of Jharkhand and West Bengal have been a little bit subdued. Going forward, we believe that these states will also grow on a robust trajectory. We are trending 10% on a 9-month basis and will be keeping the thrust on volumes. However, I'd like to take this opportunity to mention that we will also simultaneously be working on levers such as geo-optimization, primarily directed towards driving margins.
Oh, got it. And secondly, on power and fuel costs, while obviously it is understood that there has been a significant cost inflation, but there was an expectation that the third quarter will start seeing some decline in the cost. But it has seen an increase for you. Is there any specific reason for that?
Yeah. During the entire quarter had an inflated number, but as Smita said, we have peaked. But I'm happy to say that as we came into December and into January, the power costs have started coming down significantly from the high levels of October and November. That was also due to the inventory which we carried from Q2 into Q3. But as we ended December and into Q4, there is a more than adequate reduction in fuel costs, and we will see an improved power and fuel costs in Q4 and beyond.
So how much reduction can we see from here? Could you give some ballpark guidance?
It will be very difficult to pinpoint a number to say what is the kind of drop, but whatever we had from April till November and then December onwards, there is substantial reduction in the numbers from December onwards. And I think when we come back to you guys in Q4, you will be able to see a substantial reduction in the power and fuel cost. Also, our alternate fuel program is also getting into a commissioning mode. And as we speak, I can give numbers for this very clearly. In Chittor factory, we have touched a 32 to 33% alternate fuel consumption, which is one of the highest in the industry. And in Vistas factory, without the co-processing commissioning, which is happening as we speak, currently we are trending at about 10-11% of AFR. And as Smita said, exit December was 9%. January we are already hit into double-digit AFR, and as we end the quarter, we are confident that we'll get a 12% TSR, and that should have a good impact in the overall power and fuel cost. Last but not the least, the overall international coal prices also softened a bit. And while in December we got a little bit more linkage coal, January with this rake shortage and rest of all the stuff, there is some reduction in availability of linkage coal. But I think with the winter going away, we expect more and more linkage coal availability. So the reasons for our power and fuel costs coming down will be, and as Smita said, CPPs have started firing in all our factories. So WHR and CPP will get into full swing in Q4. AFR increased to 12% exit rate, more linkage coal and overall tempering of international crude prices. There is going to be a sizable impact in the power and fuel costs in Q4.
Sure, thanks for the elaborate reply. But just to get into numbers, what was the rupees per kcal cost in Q3?
Okay, just a minute. Our Q3 rupees per kg, if you see, look, Q2 FY23, which we finished last quarter, was 2.64, and it peaked at 2.74. December exit is much lower than 2.64, and then on, I guess that's how we can look at going forward.
Got it. And linkage coal share was how much in the quarter?
In this quarter, we got about 14%. Technically, we have the linkages to the level of about 25 to 27%. But Q2, it trended at 10 to 12%. So in Q3, it improved to 14. But as we go forward, I expect this 14 going to 17, 18 in the coming 2 to 3 months.
Got it. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. A couple of questions. One, just a follow-up question on the cost. I think in the presentation you mentioned the slag prices have also gone up. Where are the slag prices now versus where they were in this third quarter? And also on linkage coal, we are hearing that there is still some tightness in availability of rakes and stuff. So in the last 6 weeks of this quarter so far, I know you're expecting some improvement in future, but where is the mix right now for linkage coal right now compared to the last quarter? That's the first question on cost.
Sorry, we were mute. So I'll just restart again, Satyadeep. In Q2, our slag price was 1,200, and Q3 it kind of hit 1,300, around 1,310. That's the kind of number. But we believe that this will get sustained at similar numbers in Q4 as well. But as you know, for overall, the slag availability is going to be a challenge FY24 and beyond. But we are now started, while we are very nicely placed with our slag type of close to 2.5 million from Tata Steel in our Jojobera plant, and then some 1 year or 3 year contracts for our Jajpur plant. So we would have always a little bit of a price as well as availability advantage in slag. But having said that, slag prices have indeed gone up from 1,200 to 1,300 rupees in the quarter, and this is the kind of number we see it happening in Q4. But if every company is going to increase their blended cement production going forward, slag availability is not going much higher by the industry. So it's going to be a little bit of a challenge going forward. We are well placed with our tie-up with Tata Steel, which will give us about close to 50 to 56% of our overall slag requirement comes from our long-term tie-up which we have. Coming to the second question of linkage shortage, yes, you are right. So there is a challenge in linkage as we speak because of the availability of rakes. But I think our teams have done a very good job in talking to the necessary people to find a way to move from rake movement to road movement clearance. So we're able to get additional coal through road movement, which is a welcome development as far as we are concerned. But however, I think we've also been pursuing with the authorities in SCCL as well as the Indian Railways to see how they can help the industry in whole. And we hope some positive response happening in the coming quarter.
Okay. Thank you. Second question on the capacity expansion. I remember in the previous call, you'd mentioned that the target is to look at 3,500 crore of net debt and then look at CapEx. And you were evaluating two different options, Gulbarga and North. Have the plans been firmed up on which location you may possibly look at first, North or Gulbarga? And secondly, any development on LC3 or any studies that you've done recently on maybe expansion in Rajasthan?
Yeah, Sudeep, I think we are pretty consistent with what we have mentioned in the previous quarters. It's very clear that the primary objective for us is to get the balance sheet hygiene going, and the numbers which you mentioned is what we are really targeting. Thereabouts, that's the kind of number. We cannot have a direct fixed number on it. It will be around that number is what we are certainly focusing on. As regards where do we expand, certainly as we mentioned previous time around, which is about either the north expansion through the brownfield expansion in Chittor via with Nimbahada mines, or the western expansion through the Gulbarga integrated and split line. As we speak, our preferred choice or inclination will be first north and then to west. But it's too early for us to really put the peg on the ground and say that the timing of announcement we will mention in one of these calls. But as I have consistently maintained in the previous quarters, every quarter will give an update to you. The update on this quarter is the following. The industry dynamics has improved. The overall margin profile as well as the profitability is certainly seeing an improvement. And I think if the same trend continues, our numbers will improve further, and certainly every quarter I'll be able to make a positive news about what's the timing of our announcement. Till then, our objective of getting our debt levels to around 3,500 crores is the prime objective, and then we would pursue that.
Right, Satyadeep, taking on your second question, we are very excited about LC3. Finally, there is an opportunity in blended cement for a product which is almost close to OPC level in performance. Given our thrust on innovation, we have done some prototyping and the product is under testing with external agencies. We are awaiting the BI specs release.
Okay, thank you. I'll come back in the queue. Thank you.
Thank you.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you. And just to clarify, sir said in the opening remarks that we are looking at close to 19 million tons this year. Last time we were looking at 20 million tons. So am I right on that front in terms of the volume? And the next year we were last time told about in FY24 double-digit volume growth. So is there any change in stand there?
Thanks, Shravan, for the question. I wouldn't be pegging a particular figure that would be forward-looking, but generally to give you the direction, 9 months we have clocked 10% YOY growth. We are entering into a seasonally strong quarter, and we'll need to understand exactly how the demand is panning out at a state level. Suffice to say that we are working on maintaining our sales thrust, but more importantly, we are working equally strongly on areas of geo-optimization, premiumization, and other margin improvement levers.
Okay, so we would not like to, or rather we would like to change our stand in terms of giving a guidance to not to give a guidance on the volume front. That's the way I should be looking at. Just to further clarify in terms of the Bhiwani, the COD, last time we said the August 23, what's the new timeline and the couple of data points on the trade share, lead distance for this quarter, and the composite cement share for this quarter?
So Shravan, taking it in 3 parts, we are maintaining our ambition towards a double-digit growth for now. Secondly, the perspective on Bhiwani, as we have mentioned earlier, we are on track looking at early H2 of next year. And I'm sorry, what was your third
Trade
question?
mix.
Trade mix, this has remained unchanged at a 71% level, same as Q2.
And composite and lead distance?
Let me just add one more thing to what Meeta said. In Bhiwani, the mill shell is arriving as we speak this month. The silos or the cement silos with clinker silo, adequate progress is made. Most of the purchases and ordering has been completed. Civil work is in full swing. Our initial target is somewhere, as Meeta said, early part of H2, which is July, August, is when we want to kind of have the dry runs and commissioning happening. So we would see adequate volumes coming out of Bhiwani in H2 next year. And as against the trade bit, I think she explained to you, which is at 71% for the company in Q3.
The remaining data point I ask is the lead distance, composite share, fuel mix for this quarter.
So the lead distance is approximately 340, remains more or less the same as in Q2 levels. Composite cement, I will put it this way, we are at a 1.8 cement to clinker ratio, and the bucket is fungible between PCC and PSC. Suffice to say, we are working towards the 2 million kind of target in PCC.
Okay, and the fuel mix for this quarter?
Can I request you, Shravan, to reach out to our office?
Lastly, in terms of the pricing, so the current prices in the month of January until now, is it average with the third quarter what we have reported, or has it slightly gone down?
As we started January, the prices are holding with respect to Q3 numbers. So there is that's how we are already on the end of first week, and we are holding prices. And in any case, as a company, as Meeta spoke in one of the answers to the question, our big focus is to get our premium going, get our geo mix going, and maximize our numbers in high annuity market, so that in spite of whether market is giving us all the tailwind or not, there is something which we have to do through our pricing acceleration program, and that's working very well for us. But the short answer to your question is the price holding as we speak on the 7th of February. I have to say yes, compared to Q3 numbers as well as January numbers.
Lastly, capex was 329 crore for 9 months, and for full year now, how much we are looking at?
We get close to about 450 crores. And the overall project outlay for all the projects is close to about 550 crores, is what you mentioned in one of the calls earlier. But as we are progressing, the spend as of now is about 329 crores, and by the end of this year, we would be around 450 to 475 crores. Balance spillover will happen to fiscal 24, but all projects are on their timelines in terms of the Nimbol expansion or the Risda AFR or Sonadi railway siding or the Jajpur railway siding or the Bhiwani brownfield.
Okay, thank you. All the best.
Thanks, Shravan.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1 on your touchtone telephone. The next question is from the line of Surya Narayan Nayak from Sunidhi Securities. Please go ahead.
Am I audible now?
Yes.
Yes, Surya Narayan, please go ahead.
Yeah. Ma'am, thank you for giving me the opportunity. Just to understand that in terms of the rail coefficient investment in the railway sidings and locomotives, we are having the highest share, around 4.5% to gross block. But that's kind of bent in. So just to understand whether because we have to bring a lot of clinker from the Chhattisgarh area to eastern part. So that is our necessity. But even in the currently we are also implementing a lot of railway projects. So just input, can you share the rail logistics versus the road logistic cost in your total logistics? And secondly, when the tangible benefits of those investments in the railway investments will flow? Thank you.
Yeah, thank you, Suryanarayan. So I will just give a very high-level answer to you. As regards the nitty-gritties of rail versus road and PTPK and then the coefficient and all, may I request you to reach out to our Investor Relations department. We'll give you all the information. But the question specific about our expansion of siding in Jashpur and Sonadi, if you had really listened to our earlier calls as well as our IPO, one of the things which triggered this project was when we acquired Imami Cements. The Rizda plant does not have railway siding, and it was all the movement was happening through road movement. And all of us know road movement of clinker is much higher than the rake movement of clinker. So fortunately for us, our Sonadi plant is just about 20 kilometers from Rizda, and hence we took a decision of expanding the siding in Sonadi plant, so that we are able to kind of store most of the clinker from Rizda into Sonadi and forward movement through rake from Sonadi into the various grinding units of Jojobera, Panagarh, Mejia, which already have full-fledged siding. Jashpur was the place where we did not have siding. It was half completed when we acquired Imami Cements. Then we took a decision to put up the siding in Jashpur. When this project gets completed, we'll have, other than Rizda, which does not have inside the factory siding, the siding will be from Sonadi. So all the clinker which moves to Jojobera, Panagarh, Mejia as well as Jashpur will be through rake movement. And all of us know the cost of clinker movement by rail is roughly about, at a full level for the company, it trends about 250-260 rupees. And by road, it is much higher, so it will have a huge benefit for the organization in terms of moving clinker by rake. Rest of the details, reach out to our team. We will give you all the details in terms of rail coefficient, lead distance, and every bit is available, and it will be easy for us to explain to you across the table.
Okay, second is that the trade sale percentage is remaining the same. I mean, nearly static, and due to the slowdown in the real estate due to the rate hike policies of the RBI. So that will be going on till we see that the trade stops on its path. So that is on the macro side. So that will be definitely impacting the affordable housing schemes or maybe LIG or MIG type of projects. Though government has made substantial emphasis on this budget, but some kind of slowdown is already visible. So my point is that as we approach the election year, next year, so we have to do a lot of the OPC sales to the government projects. So in that case, the power and fuel cost will be definitely higher. So how you are going to take on the market, especially when up to 23 we are seeing a lot of investments in eastern side as well as the northern side is happening to say 38% rise in the eastern market and northern market around 22%. So there will be definitely market share loss on our side. So how you approach the market with competition? So are we seeing lower realization going forward, or how we will be going with the market? So thank you.
Suryanarayan, I will take your question in two parts. Firstly, the opportunities which open up with the union budget and the run-up to the elections. The opportunities that open up will drive the overall growth, which will provide opportunity for cement industry and individual players to grow. However, I would like to reiterate that as an organization, when we have a strategic footprint for improving our trade sales, our business model is designed to take that trade share, by which I mean we have strategically priced brands, triple brand franchise with Concreto, Duraguard, and Double Gold. We have an over 16,500 direct dealers and 3 times the numbers as a sub-dealer base. We continue to invest in brands, not just in terms of advertising and communication, but I shared during the short speech, through continuous product innovation, value addition, and consumer connect programs like our Tech Express vans and Nuvo Nirman. So it is not just the opportunity opening up, but it is our commitment and strengthening of our team with the right design and support to drive IHP business. I hope that answers your question. It also indicates in our overall trade share remaining over 70%, which, as you know, is significantly higher than the industry average.
You don't expect the trade volumes to go down, I mean, or the share of the non-trade volumes to go up. You will be definitely seeing, able to get higher share in trade sales in the face of the competition.
Sorry to interrupt, Surya. I would request you to please come back in the queue.
Okay, thank you.
Thank you. Participants, we request you to please limit your questions to 2 per participant. Should you have any further questions, you may join the queue back. The next question is from the line of Vishal Periwal from IDBI Capital. Please go ahead.
Yeah, thanks a lot for the opportunity. Sir, I think you briefly commented that, the primary objective is to reduce debt and then to focus on growth. So over how many quarters, I think, that we are targeting to reach to the desired number of 3,500 or maybe around about, because currently we are at roughly 5,100, 1,600 crore kind of difference is there. So what are the internal targets that we have?
Look, I cannot do a crystal ball gazing of how the fuel prices will look in the future. We all have some forecast of where the international fuel prices. If we spoke to you, say 6 quarters back, when we had listed and come to all of you on a call in September 2021, the whole dynamics was totally different with the prevailing fuel price and then the overall EBITDA per ton at that time. But unfortunately, a lot of things have happened from then till now. So hence, we are also very clear, when we went to IPO, we were very clear, 18 to 24 months from the listing date in August 21, we said we will be ready to reduce the debt levels of the company to an acceptable level and get our expansion going. But along the journey, we also realized that a lot of market dynamics have changed and there are huge headwinds. So I won't underline the word primary objective, but I think prudent business sense is to ensure balance sheet hygiene is good. Hence, we really looked at the objective of ensuring that we come into respectable levels of debt before we get growth going. Having said that, we also have very good ambition to grow the business. A little while ago, I mentioned that while we'll do 19 and thereabouts volume this year, we still have scope to grow this company to 25 million tons, which is good 6 million tons or 25% headroom. You may still ask, the industry capacity utilization is lower. How are you expecting your capacity utilization to be pretty high? Running the company at high capacity utilization is the DNA of the erstwhile company and the current Nuvoco. We used to operate in the past at 90% capacity utilization, and in some months we have operated at 95% capacity utilization, and we are banking upon our DNA to go back to operating the company at 90-95% capacity utilization. That is how we'll navigate in the next 24 months. But I'm assuming and being optimistic here that the overall fuel prices and international prices will come down over a period of this year, and coal prices will taper down, and then our EBITDA per ton will increase, and thereby we will prepay or faster repayment of our debt. And as I said, I can't give a timeline to you whether it will be 3 quarters away, 4 quarters away, but suffice to say, commitment from all of us is every quarter we'll come and tell you that what's the outlook. Secondly, every quarter we will reduce and pare our debt. And you would have seen in the last 3 quarters, quarter upon quarter, we have come and given you a debt level which is lower than the previous quarter. And you will see it in March and you will see it in June next year. Our debt levels will be sequentially reducing going forward, and that will give us confidence that we are in the right path to bear the debt and grow the company.
Okay, thanks a lot for the detailed explanation, sir. Continuing on this particular thing, so from an industry point of view, in the east side, I think given the players are increasing capacity, so what according to you could be market share? Maybe what is the industry capacity addition which is happening according to in the next 12 to 24 odd months?
So Vishal, we've been asked this question in earlier calls too, and I would like to reiterate that when you look at the demand and the capacities particularly in East should be read both in terms of cement and clinker capacity. And if you take a look, clinker capacity is going up from 43 million tons per annum end of March 22 to 56 million tons per annum in the next 3 years. If we were to translate this in terms of cement at a cement to clinker ratio of 1.6, we would be facing a situation of over 90% clinker utilization in the region. There's a lot more grinding capacity which is being added. There is an apparent situation of bunching of capacities in the coming months. But as we mentioned, the demand outlook in the months to come, given the robust union budget thrust, as well as the upcoming elections, there should be enough demand to absorb the additional supplies.
Okay, sure. One last thing on the AFR, in a PPT we mentioned that our fuel cost is roughly 1,611. The AFR that we use on a like-to-like basis, what exactly is the costing for the same?
Okay, so it's roughly the rupees per million cal fuel. One of you gentlemen asked what is the cost of fuel for Nuvoco. The pet coke as well as the blended coal rates are trending at anywhere between 2.6 to 2.7, whereas the AFR for Nuvoco is trending at 1.6 to 1.7. A good rupee 1 per million cal reduction versus coal and AFR. That's the kind of arbitrage we get.
Okay, sure. Yeah, that's all from my side. Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi, thanks for the opportunity again. So just wanted to check on the working capital situation. Like generally we have been seeing some reduction in working capital as fuel costs come off. So could you just guide on the expectation on the same?
So good evening, Amit. So basically, as we move into the season, so Q4 we are expecting a reduction in the working capital, and that is going to help us, along with the operational profit, that's going to help us reduce the debt.
So could you just help quantify it a bit? How much of release are you expecting in, let's say, Q4 specifically?
Can you just be more specific?
No, I was saying that could you just quantify roughly ballpark number, like with how much of rupees per crore number kind of release that you're expecting, just so that we can better think of the debt number?
Yeah, so we are looking at a reduction of working capital to the extent of around 300 crores in Q4.
Okay, that's all. Yeah, thank you.
Thank you. The next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir. Good evening. Sorry if I missed in some of your earlier comments. On per kilo cal, how has been the fuel cost in Q3 and what is the trend for Q4?
Thanks, Rajesh. This question got picked up earlier, so I mentioned in the earlier statement that the Q2 numbers for the company was 2.6 to 2.64 rupees per million cal. Q3 we peaked at 2.74, and as we stand in January, we completed January, we are already come back from peak levels to slightly lower than even Q2 levels, and then that's going to kind of continue in Q4 of this year. And as it stands with the kind of coal prices prevailing, going forward as well, this is the kind of number. So we already peaked and we've come down substantially from peak levels in end December as well as in January and February as we speak.
Okay, so Q4 you're looking below Q2 numbers, right?
Around that, yeah.
Okay, and basically current spot prices and all, can it come closer to 2 rupees in next, say, 2 quarters? if the current prices were to stay on your fuel mix?
That would be very difficult for me to say. Can I request you to connect with our team? Because right now offhand I will not be able to calculate the mix as well as do, but
no issues, sir. I'll get back.
But certainly the petcoke purchase price is trending at about $180 and imported coal is about $145 is what we are trending currently. That's where we're moving. And with AFR coming in, which is going to be somewhat good for the organization. I spoke in my earlier one of the questions that we closed December at 9% TSR, and then in Q4 exit is going to be 12% TSR. So when we enter next year, our pre-processing, co-processing, carbon black for North, as well as the rest of all the AFR is going to be fully running, and we are expecting at a company level at 12% substitution rate in fiscal 24.
Okay. Okay. And in terms of the freight cost, how is that expected to trend, sir?
Freight cost, one of the challenges for the entire industry is the railways have come and put back the busy season surcharge, which was not there for the last 2 years. Unfortunately, that has come back, and then there is also news that it's going to be for full year and not only the busy season. It's no more a busy season surcharge, it's going to increase in freight rates. So having said that, so the prevailing distribution cost for the company in Q2 and Q3 is likely to continue in Q4. However, one of the things which we are aiming for is the availability of wagons will improve going forward. And if that were to improve, our distribution cost should come down from current trending levels of about 1450, because there's a lot of road movement we have done on clinker because of non-availability of wagons. So if the non-availability of wagons, wagon availability improves from semi-finished goods movement of close to about 310 rupees per ton, the clinker movement cost will come down to 250-260 rupees per ton. There we target another 40-50 rupees reduction in distribution cost only by virtue of moving from road to rail. Rest of the initiatives that the company is focusing on is to improve the geo mix and focus on home markets and also get the Bhiwani going, means then I'll sell a lot of cement in Haryana and focus on Rajasthan and Chhattisgarh. The primary freight as well as the overall distribution costs should come down to better numbers than what we are currently trending.
And sir, in the presentation, sure. So, and by when do you expect this trend to play out, the wagon availability to a greater extent?
I also mentioned in one of the questions that we are proactively engaging with the ministry to see how they can support the cement industry. Obviously, we have to talk for the industry, plus certainly for Nuvoco we always represent. So there is a positive view that maybe the wagon availability will certainly improve going forward moment the coal stocks in the power plants improve. So I foresee as we get into fiscal 24, overall availability of wagons will increase, and also there is this announcement which all of us would have seen. The Indian Railways is probably making about 10 wagons. It's a huge number which will come into the system. I heard the Rail Minister speaking in one of the meetings about focus on railways to build more wagons. So it will not happen overnight, all of us know, but certainly over a period of 3 to 6 months, the overall wagon availability will improve, which will positively impact the cement industry.
Sure. So thank you. Last question, demand numbers, you mentioned double-digit growth in both east and north markets. But for you, if I look at the volume growth, sequentially has been flattish, just 2%, and year on year also in single digit 6%. So could you just throw some light that why you were not able to grow on a sequential basis?
Rajesh, this was covered in my speech and in a question earlier this afternoon. While the eastern region demand growth has been good, if we take a look at the regional dynamics, states of Bengal and Jharkhand were somewhat subdued, and we have a fair bit of our sales there. However, we see with the budget, the elections, and all a quick catch up in these two states. So still chasing our ambition for the year. And also would like to take this opportunity to mention that we are working very strongly on the levers of geo-optimization and premiumization. So the focus will be on driving margin-based levers.
Great, sir. Great, ma'am. Thank you. All the best.
Thanks, Rajesh.
Thank you. The next question is from the line of Shubham Thorat from Perpetual Investment Advisors. Please go ahead.
Hello. Thank you for the opportunity. Am I audible?
Yes, Shubham, please go ahead.
Sorry, Shubham, your voice is breaking up in between.
Hello. Is it better now?
Yes, much better.
Yeah. So just a clarification to begin with. So we mentioned in the earlier comments that the Bhiwani plant will be commissioned in early HP FY24. So can you please state that what would be the total capacity for this Bhiwani plant after the completion of this capex?
Yeah, currently our North capacity is close to about 4.8 million tons, and the mill which you're putting up in Bhiwani is 1.2 million ton capacity, and we take the North capacity to 6 million tons grinding. Along with that, Chittor factory clinker debottlenecking happened last fiscal. Nimbol factory clinker debottlenecking is happening as we speak. The plant is under commissioning for that expansion, with the additional clinker between Chittor and Nimbol, and also with Bhiwani grinding capacity coming. By July, August in the coming year, early part of H2, we would be at a installed capacity of 6 million tons in North.
Okay, thank you for that. And a couple of data points if you can provide. Can you provide the fuel mix and the lead distance for last financial year and the FY21 as well?
Nitty-gritty details, can I request you to reach out to our investor relations, please? We'll provide you all the details about lead distance, railroad coefficient, fuel mix, everything we'll provide you. Just reach out to our team and we will be happy to give all details to you.
Okay, sure. Thank you. And wish you all the best. Thanks.
Thank you.
Thank you. We'll take the last question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thanks. Sir, you mentioned the Nimol clinker debottlenecking. So by when it will be done, and the Risda 5000 TPD debottlenecking which was remaining, so when it will be done?
First, Risda, we are done out at 11,500 TPD. We could still take about a little bit more, for which we have to modify some fans. I think with the next shutdown in the coming fiscal, that should be completed. But in terms of Nimbol, as we speak, all the work is happening. The hopper bins and additional roller press are all being implemented. We will just have to take an appropriate time, opportune time in April or May, when we build adequate clinker stocks to take the shutdown. Otherwise, the project is on stream. So we'll take a sensible call in Q1 of next year to take, because the shutdown will take about 25 days. So we will choose the right window to hook up all the systems. Our target is by the time we hit July, August, Nimbol factory will be at 5750 tons per day capacity, 1000 tons more than what it is currently slated to give.
Okay. Again, just trying to clarify in terms of the volume front. So this quarter volume, though ma'am has mentioned in terms of the West Bengal and Jharkhand issues were there. But even if I look at the Q3 FY23, so not the last year, even the previous last year. So at that time also we have done a 4.86 volume. And after that, this time we have a higher 1.5 million ton extra capacity. So despite that, this problem in these two states are so significant that we are not even able to reach that. And does this problem now sorted in January, or still it is half sorted and half problem is there?
I think if one were to kind of simply sell volumes, it would not be that difficult to sell volume. But we took up, as we mentioned, Meeta mentioned multiple times in our call, our focus has been to get the mix going and also choose the geo mix as well as the premiumization. So if it was simply going and dumping volumes, we didn't take that call. And hence, the primary endeavor in this quarter has been to ensure that we get the margin profile right, which I think we have made a big improvement from what it was in Q2 to Q3. We are pretty pleased with the effort which we have put and the results which we have got. And I think we'll continue with similar effort, but this is a season for cement. January to June, we would certainly not lose an inch in the marketplace and get the volume as well as going, but the premiumization and geo mix will also be a criteria for us.
Okay. Okay. Thank you.
Thank you. I would now like to hand the conference over to Ms. Madhumita Basu for closing comments.
Thank you. Thank you all for joining us today. I trust with the short comments in the opening remarks, followed by all your questions and our responses, we will have closed the top line takeaways from this call very well. My team also tells me that it has been a long day for most of you, and there's probably another call coming up. So I will not take up more time for closing remarks. My team and I, the Investor Relations Department, is available for any further clarifications that you may require. Thank you once again and wish you a good evening.
Thank you very much. On behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.